traders, I wanted to touch base with you since I have been just immersed in market moving news, whether it is, of course, coronavirus headlines, otherwise known as COVID-19, or policies or, positioning coming out of the White House. I have very, very much been absorbed with this, kind of like the end of January when I glommed onto this as a theme, and I wrote about this being the story of 2020 back on January 22nd. Well, we are now March 10th, and I am just as concerned as I was back then, but for reasons of seeing that the market that had ignored this situation tremendously right up until February 18th, then of course gave it all back and then some. We have obviously corrected 19.5%, so not the official or whatever, 20%, but it is more important that I kind of come out of this market timing call mindset, which is day to day, and I do that in my trading room, and you know that, and it's been going really well, obviously. So when I had that initial feeling of something's going to break, to the rollover on that Monday, the 24th, and this just massive distribution for a solid week, and then a solid week of sideways with very large intraday ranges. Then we got into a situation where I said, if we don't have an intervention this past Sunday night, I said this on Friday, obviously, we're going to hit 27.78. And I was quite surprised we didn't get an intervention, but we did get a little boost over the cliff, which was obviously the oil war, Saudi declaring as such, and then Russia, of course, piling on. So we can get into all of that on a macro framework, but I want to kind of back up and give you my kind of rationale for being absent in some of the writing, if you will. I've been really, really in research mode every day. I mean, every single data point I'm trying to confirm and assess the seriousness, if you will, of the effect of not only coronavirus on confidence and, panic buying, but later economic impact. And I've been doing a lot of work on my intermarket analysis stuff, which is showing a big change, obviously, in the recession theme coming to a theater near you. Even the credit markets have repriced from that 13% to 60% in 2 days. And so there's lots of negative. Now, we do have potential for a bounce. There is a 2-bar reversal currently on the daily, and I did mention I have 2666. That was my price target, basically this 200 week. And when we gapped down on Monday, we had a solid week of distribution. Then we had a ginormous inside bar, 1 week of basically consolidation. We took out the Friday lows, and here we are. So we did hit this 27.78, but then we bounced, and we bounced pretty strongly. I still contend we're going to head down, but my concern now is actually growing that we're going to break it. Now, we've had a big advance. We have policy being thrown at this coronavirus. Whether it's passable or not in the House is another matter. Saving shale today was a big surprise for me. Ian, by the way, you had asked me that at the very end of the trading room, and you were right. So they did, Trump did not allow shale to puke after a momentous 10 standard deviation move down yesterday in oil. There is policy to keep the zombie companies alive, and I equated that obviously to basically trying to resuscitate a coma patient who's in a vegetative state versus funding for coronavirus and such for prevention and treatment testing. Let's just get testing. And then, of course, all the other economic ramifications. So, saving cruise lines, which are a luxury, airlines, shale companies, which are zombies, or I should say respectable vegetables, is right now the path versus really addressing how to do an economic policy to give faith back into the markets, bond markets in particular, as credit continues to blow out. This is really a concern because right now their idea of passing payroll tax reform so it would bring it down to zero to help Trump get elected is really not going to help the case if Social Security and Medicare aren't funded, and that's obviously a big, huge entitlement program, but it's also very, very important for seniors. And we have a lot of, let's say, political and economic drama going on right now. I want to just show you some of my rationale for why I think this is not going to be a sustainable bounce. So I think they're going to, they're trying to save shale, and they're talking about rolling back, repealing whatever the payroll taxes. All of this, whether it gets passed by the House or not, is very suspect. And I think that if we get a bounce, which, by the way, we may very well have some continuation off of this, let's call it 2740 low, and it is a 2-bar reversal, so it can actually see some follow through tomorrow. This H pattern is still in play. It did hit the 78.6. It did hit my weekly 2778, which was my target from Friday into Monday. Obviously, we took it out. I think we can, clearly have some bounce activity. If we get above the 3-day, move into, 2930, the 8-day. I don't think we're going to clear very easily, these higher levels, if you will, of 3100. And the CTAs are still gamma negative. The quant vol strategies are still strongly, and we've been playing this perfectly, I got to say, in the room. They're covering at the end. They're rolling puts. We got options expiration next week. We also have the FOMC meeting. I have a thesis that we're going to trade lower. And then once the FOMC meeting is done on the 18th, we have the expiration, obviously, on Friday, Fed meeting on Wednesday. Would not surprise me if the Fed cuts a good 75 basis points, maybe 100. JP Morgan says 100. That's what the market's demanding right now. This will bring, I think, then the relief bounce, a more sizable relief bounce. But between now and Wednesday, and that also, again, theta decay with the puts that will be expiring next week, I think there's a big chunk this Friday, and then there's a bigger chunk next Friday. Puts are still leading. Volatility is still bid. We had a big move, I would call it short covering rally at the open, and that's just enough time to get in there, if you will, and reshort. I said this morning, I think it's a fade. This, to me, at the end of the day, has also been bid up, but we had the economic policy pandering at the end of the day, which helped elevate a really big move, which has also been happening at the end of the day. So a lot of this is kind of predictable. And there's still some pretty big divergence happening underneath the market. In my intermarket analysis, some price targets that haven't been tagged. And I want to go over a few of those and kind of show you where I'm at. So on a macro standpoint, we have some very tight financial conditions that have occurred since the drop, the unprecedented rate of change drop in yields. This is the tightest we have had since 2009. But why I call your attention to this is because it can get a lot tighter. And I think that some of the indicators that I've had showing that it could be 2008 worthy, but not yet confirmed, are really keying in on the potential for a 2008 redux. So I think that there is growing evidence, at least in my intermarket analysis, that this could actually turn into a financial crisis. And I showed that in the trading room this morning and actually explained that I was depressed about it yesterday. So, calling this and staying short, and then the chop, and then off the cliff again Monday, And, this is day to day. I'm spending an enormous amount of time watching for signs underneath the surface, as well as headline risk. And I'm just definitely looking for confirmation that this is a bullish case or confirmation that this is a bearish case. I don't have a predisposition either way. But yesterday I came to the realization that I think this actually is going to turn into a financial crisis this year. And it wasn't just the macro data of coronavirus, which I've been absolutely on top of far longer than I should be, honestly. And this whole, technical analysis, which is very helpful, but it is not the same thing as having a narrative right now support the intermarket work. And part of that is, of course, credit, and it is right now hurting. 2 days ago, investment grade was only, pricing in a 13% chance of a recession. In 2 days, as that market has just imploded from the oil drop and also the equity correction, it's now up to 60%. One of the indicators I obviously am looking at all the time is this credit market. The other is plain old-fashioned dollar-yen carry trade, and it is getting very flash crashy. So I want to show you that some more, but there's something else that has me very worried. I'm going to kind of flip ahead here. By the way, tips also dropped, biggest 2-day drop in tips. I can't find it now. Anyway, huge gyrations, if you will, in some bond vehicles for sure. LQD finally gave up today. HYG looks like it's headed lower. It has, 20%, I think, representation of shale and junk. JNK has 40%. And even though Trump came out and said we're going to save shale companies, and they are really going to work to do so. They're going to, it appears, try and rewrite contracts in regards to the royalty, which is obviously a big headwind for shale producers, and not to mention government, loans, so a backstopping. That's not going to be popular with a lot of folks, but the fact is it does save shale. So hopefully that'll help stabilize the credit markets for the bulls, but coronavirus is undoing any good right now. So I have a recession watch. You saw it, my first intermarket chart of this weekend. Here's my second one. It has not really triggered. This is a monthly. So obviously I need to wait quite a long time. But it's been a pretty good kind of indicator of recessions. So, I'm going to keep watching. That's 2011. That's 2016. It's now doing it again. And you know my rule. Third time you're out. So it's tagged once, twice. I think the third time it goes through. So recession to me is a high probability. And the market is kind of catching up to that. Yield curve has been inverted for a while now. And that's obviously the very first tell that it's, 12 to 18 months out, and we're getting there. And that's the chart that I showed you. But I think this is also very indicative. I'm fascinated with the dollar right now. I am fascinated with crude stabilizing. Both of those, by the way, are big important drivers or inputs. But I'm also looking at some of this intermarket stuff going, okay, typically these spikes are very bullish, right? We might have some chop, which I absolutely have talked about. Volatility is going to stay bid for a good 2 more weeks, a solid month. So when this happened, my contention was, hey, we're firmly in backwardation, and it could be months before we stabilize, but at least a month with extremely elevated volatility. So if they throw the kitchen sink in regards to economic policies, fiscal policy, then we might have a chance, obviously, to bounce strongly and reverse this exceedingly oversold indicator and have, the bull's requisite V shape. I don't think so. To me, this mirrors much more the risk off environment of 2018, and that means more waterfall type event coming up in my book as it relates to intermarket. So a lot of stuff is still very oversold, and this is a process, right? This took many months before we actually moved higher. 2017, that was into the election. This, by the way, is a percentage of stocks above the 200-day. That was the V shape, if you will, of Christmas Eve. And München, by the way, was on the phone, right, with the plunge protection team, for lack of a better term. And this is what happened. Also in October, there was Repo Madness, and there was another phone call, München, with the cast of characters. I retweeted this earlier, actually. And so we should, but I have that 3-time you're out kind of thing. The market's really going to get tested. Is this another situation where, they do come in and intervene? We had a $220 billion repo, undersubscribed, but still the numbers are getting bigger and bigger, and the diminishing effects are clear. How much time does it take to get that money to the trading desk? Well, right now, I don't see the volume coming in and the stabilization coming in. I actually see lots of area where this still needs to bottom. So that's my contention, is that we still have broken in so many charts, it's ridiculous. And we've broken all the moving averages and trend lines, and we've undone basically, a solid 2 years of gains. This is the Nikkei, and as the yen continues to move higher, this continues to move lower. The DAX, which I recommended, this is just way too likely to move down, and sure enough, this is not, to me, even done. So we've got a gap down, some stabilization should be coming in. But look at these MACD indicators. This is financials. When rates just obviously fell, this is a ratio chart. This imploded as well, and the margin very bad for banks. The net margin, if you will, from these basically not negative rates, but pretty close. Anyway, this is, I still think, lower. So there are lots of indications of stress. We can see it in the dollar yen. We can see it. Tips, that was just yesterday. Today it completely reversed all the way back down. So I'm looking at potentially more. I know that sounds shocking. We've had such a rollover in bullish percent index, but I see more. I don't know what else to say about that. I've shown you this gold SPX ratio chart. That's where obviously the SPY drops down, and gold, and I wrote about this, doesn't even have to go up. So it just stays the same, which is exactly what gold has done. And this can still indicate the SPY rollover. We do have exceedingly lower levels that at some point should serve as oversold rally material, but they can also indicate 2008 type of sentiment. And I'm seeing this more as 2008 type sentiment all the bloody time. The yen is so freaking bullish right now that it's scary, but it's a complete and utter parabola waiting to reverse. So I look at this and I think we could have this type of consolidation for several months in the currency trades, in volatility, in choppiness with the S&P. I still see lower to the 200 week. Nothing really has changed. I wanted to kind of go over, this is NASDAQ. Breadth under the surface is still deplorable. And again, this can stay lower for longer than seems reasonable. Some of these charts, this is the value line geometric index, is just completely waterfall already. And that was my first indication. As soon as it broke this stacked moving average support line, which was also weekly support, I knew we were in trouble. Like massive distribution underneath the surface. And I'm going to show you those charts in a little bit, but you can see lots and lots of S&P stocks are just falling. And right now, only 17% are above their 200-day moving average. So that's weakness, and I don't contend this is going to be V-shape. I absolutely do not think this is going to be V-shape. And I'll show you some of the other indications of that. By the way, this is very, very oversold, as it was at the Christmas Eve massacre and, you know, the period of 2016. But you also notice that this can take a few months to work off. So it's not just a one-day wonder. I don't think it's a one-week wonder. I don't think it's a one-month wonder. Okay, so these are my lower levels in the New York advanced decline cumulative, which indicates lower. I still think we're going to head down here, probably 2,400. It's not a one-to-one relationship. I'm just kind of looking for next area of potential support. So you can see I'm bearish. There's some things I want to kind of point out. This is exceedingly high, and yes, volatility is continuing to get bid. They're expecting, the call buyers are like looking at 100 on the VIX. This is still firmly in backwardation, and stocks are not safe from a portfolio standpoint until they're back in contango. But for right now, we can play intraday, and that's what we did, and I do every day, but this is something I want to kind of point out to you, that this is the largest expansion, even beyond, beyond 2015 yen devaluation. I mean, it completely changed my axis when this blew through. But I have a bigger thing. I think that this is actually going to roll over some more, despite this put-call ratio being off the charts low. We're at, 0.55, which is also a Christmas Eve kind of number, and gives a lot of credence to some kind of bounce. But I haven't seen the bottoming yet. Today was the first attempt. Yesterday, actually, I said that we had like a 96.5% down day. And that was a good place for stabilization and a bounce. And today we had the bounce. So that, again, I'm reading this intraday pretty well. I don't know what we're going to do, honestly, from this bounce point. But I can tell you that if we break SPX 2734, that's the low of today and yesterday, which formed the kind of two-bar reversal, we're going lower faster. So 2734 really needs to hold for a bounce, and then if it does hold, this little indicator of mine will stay elevated in this space, and the S&P can rise a quick 100 points easy. And that's not so much, but I'm just saying it's a good chunk to chase. This is another indicator I am fascinated by, because it just does not seem to want to have any stabilization. This is the NYSE, my composite index, and it is just off the charts through every single indicator, and hasn't found a bottom yet. Wow, that's all I can say is volume under the surface has been massive, and the advanced decline fall has been unprecedented. The bond move this morning looked like a poltergeist, fat finger kind of shock, and the tips rolled strongly over 2 days in a row. The dollar, the yen is screaming higher 2 weeks in a row. So we definitely have dislocations in the market, no question. And Trump is now all of a sudden, after weeks and weeks and weeks of saying no big deal, no big deal, no big deal, is saying we have to massively stimulate. So out of the blue, they're concerned. And I'm concerned because Congress goes on vacation Thursday afternoon for 10 days. If there's not some kind of impetus here for stimulus, bipartisan support, I think we're going to have lower quicker. So the Fed already, we've baked in a rate cut, a significant one. We need fiscal. We need infrastructure talk. We need coronavirus relief. We need CDC testing action. We're not getting any of that right now. Zero. That to me is what the market priced very quickly. Fastest 10% drop in a week ever, and fastest 8% drop in 17 days ever. It usually takes 59. So there's broken stuff, and I'm not going to let go of the thesis that we are heading lower. This is definitely broken. This is a bigger picture. I just wanted to show you when I kind of indicated we had hit this yellow, right? And I said, uh-oh, risk off. And it also looked like a kind of a head and shoulder or double top. Seriously, I thought we would bounce here. And then we'd, bounce here. I thought it'd be like July before we got to where we are. Anyway, we are extended. But if you look big picture, we have not even caught up here. These moving averages, MACD, of course, is sold off. Breath is very quick. But we have to catch down to it with these moving averages, which to me tells me that there is more to go. It was very fast. We could have a little bit of a bounce, but this is not a safe look. So I'm just kind of going over some of these charts that I've taken and gone over in my trading room. This is HYG, by the way. It looks kind of funky, but it's the IEF HYG relationship, and I have been tracking this, and as you know, I said this is trouble, right? This kind of shoulder, head, shoulder, and then boom, it broke above and broke right through the channel with violence, if you will. And now we got to see if there's going to be any stabilization. But there are some levels here that just with shale being saved, if it gets passed and all, to me it still looks bullish. So stock bond volatility ratio work that I do, I have been very, very, let's say, adamant that this would shoot higher. Got that, but I thought we'd pause here, and then get above. No, we went through every single moving average, every trend line, and then pulled back to support last week when we did the sideways gyration, and then we just shot right higher. What you can't see and appreciate so well is that this little yellow line is the 200-day moving average, okay? That has not been penetrated since 2008. So I realized yesterday that this was going to be that this happened, right? This near 20% pullback, but which I timed, which I saw. But then I realized yesterday, oh my God, we actually have a totally confirming, for me, I shouldn't say confirming. I have to have this Friday read. It's actually a weekly, but I have to see this at the end of the week. But this particular explosion higher, which I have, anticipated, and these moving averages haven't caught up. We're coming into yet the underside of a trend line where it should slow and, come on down. It's way extended. I understand that. It's the biggest move ever. I understand that. It can become bigger. It's still bid. The market's still bid. Coronavirus is still gaining. We're going to have 10 days from now, we're going to have exploding numbers. But my point is this: if this closes above the 200-week moving average, it's risk off. It's financial crisis. We have not had this indicator that high and above the 200 since literally October 2008. And then it went higher. It went a lot higher. So I'm very, very, let's just say, wide awake that we're going to have some issues. Now, I was expecting with VXX to get up to this trend line. It has not tagged this area, which basically call it 45. It came awfully close. You can kind of see, but it didn't tag, and I'm kind of a stickler for that kind of activity. We definitely had this morning my T2 104, which is cumulative volume. It tagged on this 78.6, and then it did bounce a little bit. So it was on the floor intraday. That's my hourly, that's my day, that's my week. That's the 200. We did tag it, okay? And that was because I took this very late, early morning on March 10th. Obviously, the day's session looks a little bit different. So there's no question that we're on some support levels. This is my high week, cumulative high week, 4-week, high low, and it has the 100 week, and it definitely has been in beautiful distribution. Yesterday was the biggest distribution day from the Tuesday the 25th. So that meant something to me on that day. I said, oh my gosh, I've never seen this have so much distribution. And then yesterday we had that 96 to 1 kind of distribution again, which was massive. So I thought that was a really good potential place for a bounce. And today we had a little bit of one, but it's just not enough to get me bullish again. I don't know what else to tell you. Even though, NYSE has, fallen all the way back down to December lows. The SPY has basically wiped out a whole bunch of its 2019 advance, actually all of it. Boeing has traded perfectly. There's so many. Apple and Microsoft have not. They definitely have not come down enough. Nvidia and Netflix, they're still holding. However, those are below the 10-week, all of them. They could fall very quickly, very easily, but right now, nothing. The dollar yen was a ginormous drop into some support. This is the one to watch, obviously, because they're trying to support and buy the yen. Bank of Japan came right out and said, "Yeah, we're just gonna buy." So I think right now my point is we've gotten some price targets that are tagged and we should bounce, like small caps. Perfect example. We tagged this gap from 2016 pre-election. We didn't tag it in the Christmas Eve massacre. So this is definitely fascinating to me, and we've left 2 gaps here. Breakaway, potential exhaustion, but I still would like to see some type of pattern, and I don't think it's going to be V-shape. So I'm looking all the time. Yen screams higher. I do my breadth stuff. I'm fascinated with this whole market, honestly. To me, it has been an exercise in learning a tremendous amount about crowd psychology and projecting out economic impact. And right now, there's no lack of fear. So that's another thing. Markets have been kind of walking on thin ice for over a year in regards to liquidity. It's getting thinner and thinner. I am also suggesting that it might be a good idea. I don't know how active you are on Twitter, but I have been engaging on Twitter, which has been really helpful, and with some colleagues as well, and getting some good information, which obviously feeds my ability to commentate in the live trading room and set up trades. So definitely, if you can, follow me there, because I am very, very interested in the news that helps position, for market. And for example, last week, the Boston Fed president came out, QE may not be effective without buying a broad range of assets. That's a big deal. So if we hear this type of activity come from the Fed next week, we'll have a rip your face off rally, right? I think we will anyway, just because we'll sell down into the Fed, into options expiration. Those negative gamma quant players that are, in the volatility strategies will probably come out of that a little while. But to me, that's a big, big deal. And then, of course, I have some thoughts as it relates to market activity, but also coronavirus. I get some really good articles, and then I can continue sending that out. But yeah, VIX hit an intraday high, its highest level since January 2009. This, to me, is just more facts to support that we have a very, very explosive market, and we're not done. It's probably going to be May timeframe before we get our arms around the spread here. So I definitely have also kind of public service announcements on coronavirus, COVID-19. This seriously is scary, but no disease actually follows an exponential path solely. There are steps involved around quarantine and treatment and care, but we definitely have some case concerns as it grows. Italy amongst them. We don't have so much trust in Iran and Chinese data, but Italy has disclosed its reporting, and it's been shockingly, frighteningly severe. So now we have that kind of carry on here of closing and quarantine, but it's very slow to move. Anyway, it is very much political as well. So there's no question I am in this mode of following politics because markets react to politics, and politics are just market moving, and markets are full of politics. So I like very much this kind of roller coaster, if you will, of data that I'm trying to figure out is going to help position all kinds of trades. Gold right now, for example, is not moving very much. It's used as collateral, I think, so a lot of margin calls in institutions or, firms, I should say, are using that. We also have Robinhood traders are in big, big pain with their failed platform, and they maxed out their credit lines to meet margin calls. Interactive Brokers, or CBOE, I can't remember, announced they were increasing their margin margin requirements to 5 times. So things are getting very, very difficult as it relates to also trading in this market. Options are extremely elevated. So we have some, interesting charts that I might not talk about in the trading room. And then, I have my interest, if you will, on coronavirus, and I'm sharing some of that. I've got some good traders in here that have their insights also on what's happening in the world of oil, for example. That's definitely a big one right now. And I think just basically bringing all this together, the macro backdrop is challenging right now. The volatility is continuing to be bid. The risks of potentially escalation with Saudi Arabia and Russia, and remember, Saudi Arabia has a lot of assets that they own that they could dump on the market. China has tremendous assets, both, property, hard assets, as well as equities. It's intimidating to think. But they have some ginormous, we have some ginormous exposure to China in regards not just to supply chains, but financial interests. So there is definitely news on the fracking industry that I think is going to also make the weather. There's an excellent article and book on this, but right now Trump seems content to siphon off dollars to loan money to these zombie companies and whatever else. It just seems really frustrating, if truth be told, with what I'm seeing happening in communities everywhere, and schools closing, colleges, universities, they're going to be just all shut down. Soon we'll see more travel restrictions. There is no lack of, let's say, bearish narrative, right? It's totally oil-driven, recession-driven, geopolitical drama-filled, corporate. I mean, this is actually a big deal. High yield pricing in a recession, probability of only 31%. It went from 13 to 31 to 60 now. So we're going to update that again. It'll be higher. I'm not quite sure if we're going to just stop at 2666. I really think that the yen carry trade right now is in trouble. And I agree that if we break 100, it is financial crisis kind of level. And same thing goes for VIX. We can stay elevated for quite a long time. I just don't see this as, as a V shape. So recession usually leads to 30 to 40% fall in equities. A big recession from 40 to 60%. We're not going to think about depression right now. I don't think that's that's a way long shot. But I definitely see recession. So we're only down 20%. We can go another 10, 20. This is not hard, given valuations and the oil shock and the coronavirus impact. I really think that that's doable. High yield is obviously unbalanced because of shale and the oil war. It could settle, but there's still a risk premium that's been built in. I think that's the bigger issue. We definitely have distribution under the surface. We definitely have commodities and credit spilling over into equities, and I don't think that's done. I definitely think these headlines right now around economic policy are going to bump up the fight, if you will, of COVID, or try and negate the COVID-19 fears. So which is more powerful, right? The cowbell or the coronavirus? There's just way too much, I think, distribution that we could still have. For instance, that 200-day on my stock bond volatility ratio, I've also said this looks like a distributive top. Markets just isn't safe. And the yen, I know they're falling, they're buying the yen, but also Bank of Japan, their holdings are going to fall below book value if we drop 3% more down. This is incredible. How do they deal? Not really the base case here of worrying about good old-fashioned Bank of Japan manipulation, but I am looking at our U.S. payroll tax holiday and how this would impact Social Security and Medicare. I'm definitely looking at whether this Congress is going to come out with anything before Thursday night's recess. And there's some good articles, by the way, in here as well. I love this. Markets walked off the cliff. Will they look down like the Willie E. Coyote? This is John Authors from Bloomberg. He does such a good job. But anyway, high yield continues to blow out. Private industry companies are trying to fill in the gaps with the lack of testing. There is, because of the coronavirus, we have, of course, a yield curve that's inverted already 7 months before the virus, but also impacting earnings. So there's a high probability of an earnings recession again. So we've already been through that. Repo is not helping. This is how much we had today, $17 billion. It's just, it's not doing as much as it used to. I mean, we rallied from October all the way till February on repo. We're not getting up off the floor. So I think this is definitely a continuation of confidence crisis that's going to turn into financial crisis. And I'm right now waiting to see how that stock bond ratio does at the end of the day, end of the week. I think we could even rally after the FOMC announcement next week. I think there is no question we will have some relief rallies that will be stunning. But I also think we're going to head back down. Clearly, I don't think 2666 is enough. Wouldn't surprise me if we head back and break through the 200-day. Below that, we have like 2400. It's only 250 more points, roughly. I think we can pretty much hit that level as the cases pick up. And this is an important kind of distinction. When I say cases pick up and everyone's like, who cares? It's only a few hundred or a few thousand people die and we have many more deaths from the flu, or we have 21 vets commit suicide every day. We have terrible statistics on opioid-related deaths. It's about the expansive nature of this containment. Italy first, and I actually had to correct this. Take Italy. They first reported 3 cases and 0 deaths. Under 2 weeks later, there were over 2,000 cases with 140 patients in serious condition in this little region of Lombardy, Italy, and 52 deaths. Even after work was closed, the schools were closed, flights were canceled. But that 2-week expansion, I was wrong. Italy says its coronavirus infections have topped 10,000 and deaths have risen to 631 overall. So that's what we fear here. Now, finally, officials are getting it. And they want to try and fix it with the Fed and, tax cuts or tax hikes if they're going to bail out shale and cruise lines. But the point is, this is not going away. So I'm not bullish. until we can get a better handle on this, until we've wiped out all of the earnings advance for the next 2 quarters basically. And I don't know what that market cap looks like, but I'm looking at 2666 this week still. That's my base case, even though we had a 2-bar reversal and we probably bounce tomorrow. Not looking at too much of a drop as we go FOMC Wednesday into Friday options expiration. But I definitely see potential for losing the 200 week and heading south. So stay hedged. Jump into the trading room. Let me know what stocks you're looking at, what questions you have. There are some definite plays within oil and gas that will be better than others. Like they're not going to let Exxon and Chevron, fail. No way. They'll do equity purchases if worse comes to worse. Whatever. You know what I mean. There's just certain plays that are going to be fine. And we're going to continue looking for opportunities and watching the news. And I will report back when I have another update. But I wanted to keep you kind of apprised of where I see things heading now after a very tumultuous 2 weeks of aggressive distribution under the surface. I don't think it's done. I think we have some stabilization, that we can have a little bounce under the surface. We have, potential, but I think this is going to be tested again, and we're going to have, this is now volume under the surface. We're going to have some more selling coming up in the next week. So take care and hope it helps.